Good morning. Stealth easing and cap rate compression. Are we headed back to the cheap money era? I hope so. In the world of commercial real estate or CRE, every investor watches interest rates like a hawk. But here's a secret most overlook: liquidity injections, not just official rate cuts, often set the stage for the next market rally. And that's what's happening right now through what many call stealth easing. So, what is stealth easing? What does it mean? Plain and simple explanation. Stealth easing occurs when the Federal Reserve quietly adds liquidity to the banking system without formally cutting rates. It's not quantitative easing or QE or a policy pivot. It's just a soft reinjection of money into the economy through operations like the Standing Repo Facility or SRF. Banks exchange treasuries for cash, boosting liquidity across the system. And in the past few weeks alone, the Fed has injected over 125 billion into banks to ease short-term funding stress. And that's not a small move and is starting to ripple through asset markets. So why liquidity matters more than rate moves itself? Well, for investors, what truly drives cap rate compression isn't always the Fed funds rate. It's how much money is sloshing around in the system. And more liquidity means more dollars chasing the same number of deals. Even if borrowing costs stay flat, this excess cash can, number one, increase competition for stabilized assets. It could push buyers to accept lower yields, and it could lift valuations, especially for core CRE assets. In short, liquidity drives velocity, and when capital is abundant, cap rates tighten. How much or how more cash in the system impacts asset values. So when capital floods the market, investors start stretching for yield. Institutional buyers re-enter core markets and REITs become more aggressive. And private equity groups start underwriting future rate cuts into today's bids. The result? Cap rate compression, and that's what we want to see. This trend can inflate property values even before official rate cuts occur. And it's a subtle, early stage bull signal that often shows up in transaction volumes, price per square foot increases. So, which property types will benefit the most? Well, not all sectors are going to respond equally to stealth easing. And here are the usual suspects who stand to gain first. Industrial remains a capital magnet due to e commerce growth and supply chain reshoring. Compressed yields are most visible here. Retail, especially neighborhood centers and service-based strip centers that benefit from stable consumer demand. Multifamily, a natural beneficiary as lower financing costs attract refinancing and acquisition plays. Medical office and flex industrial may also see early activity due to their hybrid resilience and tenant stability. So let's talk about positioning before the next rate cut cycle. Well, savvy investors are already repositioning portfolios for a softer monetary backdrop. And what does that mean? Well, it could mean refinancing short-term debt while spreads are stable. It could mean acquiring stabilized assets in strong submarkets like Katy, Fulshear, and Brookshire before competition heats up. And you could also look at locking in long-term fixed rate debt while it's still available. And if history is any guide, stealth easing often precedes a broader easing cycle, and those who act early stand to benefit the most. So here's the Houston angle, the submarket advantage of our area. West Houston submarkets like Katy, Fulshear, and Brookshire are uniquely positioned for this next wave, and these areas boast, and they'll bring boom to us. So high population growth is one reason. Expanding infrastructure, so think Grand Parkway or FM 1093 or the Texas Heritage Parkway. It increases investor interest and stabilizes retail and industrial. And when liquidity flows back into the system, investors often migrate towards high income, high growth markets like Katy and Fulshear, who are near the top of that list. So here's some final thoughts for the day. Stealth easing may not grab headlines like a rate cut, but it moves markets all the same. And as liquidity quietly returns, cap rates could compress, valuations could climb, and competitions could reignite. For CRE investors and business owners, now's the time to prepare for a market that's slowly and silently turning back towards cheap money. That, my friends, is it for the day. Please visit my website, houstonrealestatebrokerage.com, to schedule a consultation. Look forward to hearing from you. Have a good day.